I'm delighted to be joined today by Brian Foster, Institutional Coverage, and Ben Floyd, Head of OTC Sales at Coinbase. Welcome to you both.
Thanks so much, Nisa.
It's good to be here.
So Brian, you recently authored Coinbase's institutional review for H1 2020, released last month. Given the size of your customer base, both retail and professional, and the range of products and services that you offer, what changes in demand, knowledge, and expectations have you seen from the institutional customers over this time?
Yeah, it's been quite an exciting period for us. I think that really the institutional landscape has just matured a lot in the past few years, and things have really come to a head this year. One of the biggest things is obviously the macroeconomic backdrop we're in right now, I think provides an interesting impetus for a lot of new participants to enter the market. So we're in this world of, abundant supply in terms of how central banks are thinking about monetary policy. And juxtaposing that is, the predictable scarcity of Bitcoin, at least on the supply side. And I think that's a narrative that folks are really excited about. So we've seen some investors who are focused on, the macro strategy come into the market for the first time this year against that backdrop. I think the other thing is just that the caliber of tools and infrastructure for participating in crypto have come a long way. Largely, I hope thanks to the work that we've been doing at Coinbase. And so teams that are serious and sort of more mature have now the toolkit they need to really allocate in a way where they can defend what they're doing to their investment team and be viewed as being responsible by participating in this market. So these are two of the biggest factors. And then I do also think there's some positively reinforcing momentum here when you have larger allocators, more serious funds who are in the space. New entrants that are on the fence can point to those peers and say, okay, XYZ firm is in the space, we can be too, and you're not going to get fired for making that assertion that it might make sense to allocate to crypto, whereas a few years ago you may have, at a minimum, gotten some weird glances and head scratches.
Right. And Ben, are you seeing any kind of sophistication change in the terms of trading?
Yeah, I think so. I mean, I think to Brian's point, we're getting a whole new type of customer segment coming into the space now. And I think it's had a long time. It's been a long time coming in that they've needed good custodians. They've needed to get comfortable from a regulatory perspective. But now that they're into the space, they are demanding a lot of the same tools that they would get in traditional markets. So whether that's kind of algorithms that allow them to be slightly more nuanced in how they trade. If they're looking to build a large position, they don't want to necessarily do that in one go. They might want to do that over a number of days, and they might want to be aggressive at a certain level while being slightly more passive at others. So I think that's definitely changed. And I think the conversations that we're having with these more sophisticated traditional asset managers, there might be a global macro hedge fund or a pension or an endowment, is much more typical of the conversation that we would have had in traditional finance when dealing with these types of participants. So I think it's been a huge step forward, and with some of the tools that firms like Tagomi built, who are obviously now part of Coinbase, the ability for us to actually execute in that nuanced way for them is that much better. And I think it's definitely we've had a great reception from all of those clients to date, not only from an execution side, but also from the reporting, for them to understand exactly where we're executing and why we're executing there, and having a slightly better concept of the best type of execution for them, and being able to create a strategy around building a position is something that I think a lot of them are getting a lot more comfortable with, and it's been a great few months as a result.
And then prime brokerage as well, which led to your acquisition of Tagomi, right? And why acquire rather than build in-house?
I think the short answer here is just time to market. So, as we engage more with, I think, serious institutional customers who wanted to trade in size, it became apparent to us over the last 2 years that we would need to move to a multi-venue execution world, just like you see in the FX markets or other more mature asset classes. And then the question just is, how do you do that most effectively? And when we met the team at Tagomi, I think we were ubiquitously impressed. Like everyone at Coinbase said, these folks are the real deal. They have deep experience in traditional markets. and above all, an incredible product. And so bringing that team in-house and being able to integrate their technologies allows us to get to that vision of providing multi-venue execution much faster than we could have if we went at it on our own.
I think just building on Brian's points there as well, the product that they've built, we've been using it now for the past few months, is incredible. And the ability for us to provide a great service to our clients as a result of those tools is something that we just couldn't do 6 months ago. And I think crypto is still a very nascent asset class, and the market structure is still relatively immature. But for that team to be able to build a tool which routes to 10 different exchanges and a number of other pools of liquidity, and giving you like a great sense of why you dealt where you dealt and why that's a good fill, is something that institutional clients are used to in other asset classes, and they're now getting from the Tagomi tools. To Brian's point, it's not a straightforward thing to build. So to bring it in-house and bring that team in-house felt like the best thing to do, and so far it's been fantastic.
And how do you address the risks that you're now introducing when aggregating liquidity from other venues? So
I guess in terms of like aggregating volume from lots of different venues, as I mentioned before, the market structure is still relatively immature. So really leaning on the expertise that Greg, KJ, Jen, and Mark and the team have from other asset classes is kind of how we mitigate some of that risk. They've all done this before in other asset classes, so understanding where you're going to have problems, where you're going to have risks is something that they already knew. So you can't 100% mitigate away all risks, and APIs are still getting built out and becoming more stable at all various different exchanges. But they definitely made some great steps to getting there. I think in addition to that, with our tool, we can actually define exactly where a client trades. So for example, if a client says they only want to trade on regulated US exchanges, that's something that we can do for them, thereby decreasing that risk again. But it's we have a few other kind of tools to reduce risk like that as well.
And you probably saw Fidelity's recent investor survey that indicated a 7% year-over-year growth in direct crypto asset exposure versus 244% in derivatives. How does that compare with your clients, and are they expanding their exposure at a similar rate or higher?
So first of all, that was a great report. Huge kudos to Fidelity for publishing that. And I think it just does great things for the space. And so I was really happy when reading that. I think with regards to volumes and derivatives growing, a lot of the traditional funds have access to CME futures via their FCM already. So the step for them to trade Bitcoin is just another ticker. So it's very, very easy for them to do that. Trading spot is a very different conversation, and it's one that requires their security team to get involved, their compliance, but a whole range of different people. So we're seeing fantastic growth in the spot side of the volumes. But the work that the CME team are doing, which is absolutely fantastic, definitely helps a lot of these more traditional funds that are trading oil futures or various other commodity futures get into Bitcoin very quickly. So it's a great thing, and it feels like a natural stepping stone to start on the CME and then try and look at other avenues to get exposure to Bitcoin.
And obviously there's trade-offs between these different products, right? So the futures and options markets allow you to express your view in some ways that you can't in the spot market, but there's obviously some sort of cost and other operational advantages to dealing in spot. And so generally once folks kind of dip their toes in the water and start to understand the kind of mix of products they can play with here, they realize, okay, I should probably be in multiple products. And so I think we're in a great position today to to serve folks from the spot market, and we're certainly paying attention to these other markets as well.
And in your report, you discussed the growing importance of on-chain data. How comfortable are regulated firms now becoming with this, and are they starting to use it for making their trading decisions?
Yeah, so I think the data space in crypto is fascinating. Just the surface area for what funds can use here compared to the traditional markets is a bit broader in that you have both your sort of financial market data, what's happening to asset prices, but then also your on-chain data, which is a super interesting kind of open source map of fund flows in the space, at least those that are happening on-chain. And so we do see, investors and other types of market participants starting to play with that on-chain data and use it in their models. I think it's still early in terms of adoption and usage of these tools. I would say that the vendors that are providing and sort of cleaning and making this type of data accessible are generally still quite young, and so they're growing up and maturing. But it's obviously a competitive advantage for funds who can figure out how to use this well. And so the interest is definitely there. I think we're just early in the cycles still, but funds that can figure out how to combine this data in interesting ways and generate real alpha, are absolutely going to have an edge. And so we do see some promising experimentation happening there.
I think what's been really amazing to see is that some of the folks that worked at kind of top tier quant funds, like your kind of Two Sigmas, etc., are kind of coming into crypto and are using this type of data to create trading strategies. And to Brian's point, it's still a very nascent part of the industry, but if they can get it right, then the potential alpha they can take out is just incredible. And it's just great to see super smart people coming in and applying some of the techniques from the traditional world to crypto and making it work.
What kind of involvement are you seeing institutions in, let's say, DeFi experimentation, staking, or stablecoins, and how are you advising them on the risks?
Happy to take a crack at that one. So I think probably worth separating these out a bit, is they're kind of distinct and viewed differently by different market players. I would say that DeFi in particular, I think there's a lot of buzz around this category right now. For the institutional players, I think they're very far away from DeFi. So this is a super interesting phenomenon, and we're excited about it at Coinbase and supporting these protocols in every way that we can. There's something super powerful about being able to just connect a non-custodial wallet to a smart contract and engage with basically financial products turned into protocols. That's an amazing new primitive that I think will drive a lot of exciting growth in the market. At the same time, these things are very new. And so these smart contracts, some of them are unaudited and capturing hundreds of millions in locked value in some cases, or others are audited, but just simply don't have the secure track record over time that would make an institution confident to participate. And then you have the whole kind of KYC AML issue where there's compliance questions, and do I really want to get involved with that if I'm an institution? So I think DeFi from a sort of product unlocking standpoint is incredibly compelling, but some of these risk factors today make it a little bit inaccessible still for serious institutional participants. Stable coins and staking, these are whole other cans of worms I think we could talk about for a long time. I'll say briefly that I think stablecoins are super interesting. We've seen very strong growth there. USDC is something that we've invested in a bit at Coinbase, but it's really run, I think, a long way, even with very, very light, I would say, involvement from the Coinbase team in terms of kind of seeding that, that community. What's encouraging to me is that when given a choice, we basically see that crypto traders and investors will use stablecoins rather than sort of exiting the crypto economy back into fiat, simply because there's obvious advantages in terms of execution and cost and speed of settlement when you're going in and out with stablecoins. And lastly, I would say for staking, just to hit on that briefly, we do see investors who are holding assets that feature staking taking advantage of that, and it's something we're excited to be enabling through Coinbase custody. The long and short of it is, if you have an asset that has staking built into it, you want to be taking advantage of that so that you capture the inflation reward and get the most out of your assets. So that's something we're going to continue to invest in at Coinbase, and empower other great partners in the ecosystem as well through partnerships.
I think to build on Brian's point there, the kind of the way, I guess, the way with the institutions is we'll have those that are kind of more crypto native, and as Brian mentioned, will be kind of staking or looking at governance and kind of getting slightly involved in DeFi, but more aware of the risks. And then you've got the very traditional folks that are the types of people that are newer to the space. They'll kind of focus purely on Bitcoin. And then some of them will start to look at Ethereum a little bit, but they are asking the questions, which is really encouraging. They do want to know what's going on, and they are intrigued. And I think Bitcoin's a fantastic kind of gateway to crypto in a way, and the they'll kind of come in, they'll follow the narrative around gold and Bitcoin being digital gold, and mainly because some of the concerns they've got around the macro that will be affecting other parts of their portfolio. But once they're in, they kind of see the world that we all know super well, that we're all super excited about. And DeFi, while slightly crazy at times, is incredible. And they kind of start to pick up on that. They start to read some articles. So it's super exciting when they start to ask the questions, and they ask the first question, but then they come back next time and they've obviously gone away and read loads, and they kind of ask a better question. So it's great. It's awesome to see. And I still feel like we're a little bit away before we get kind of the true traditional institutional money into that space, but they're looking at it and they're learning, and that's, at this point, I think that's all we can ask for. Right.
Well, great. We look forward to more exciting developments, and thanks so much for joining us today.
Thank you, Nisa.
Thank you, Nisa. Thanks so much for having us. It was great fun.